Good morning, everybody. Welcome again in 2022 to our IFRS webinar series. And we will start with an interesting topic, sometimes very theoretical, but requires quite some judgment also. And it's about consolidated financial statements. And when do I have control? Or when do I have joint control? Or when do I have only significant influence? And besides that, there's also quite some disclosures that we need to include into the financial statement. So we will talk about IFRS 10, IFRS 11, IFRS 12, which deals with disclosures, and IAS 28, associates and equity accounting. For those who are new, some very quick, I will make the presenter mode. Yeah. Some logistics for the webinar, that everybody is muted. We will try to meet the deadline of 1.5 hours. I think it will certainly be possible. You can ask questions. There's a, in the GoToWebinar app, there's a question button or question pane that you can ask your questions. We will try to respond to that during the webinar, or if it's not possible, we do it afterwards or later on through email with you. There will be a short poll after the webinar, just requires only 30 seconds to complete. Slides are available in the handout section. So again, in the pane handout, you can download the slides of today. If you don't find them, no problem, send us an email and we will share them with you with an email. And finally, the webinar will be made available afterwards on our website. There's already a lot of content on our website about our previous webinars. I think we have about more than 50 hours of webinars on IFRS topics, or maybe some tools that can help with IFRS. So don't hesitate to have a look to the other webinars of previous webinars that we have been giving in 2020 and 2021, because it's already our third year that we are presenting this IFRS webinar series. Speakers for today, you have me. I'm a partner at Finvision. We will have Thijs de Smet and Evelien Reinebouw, both are a manager in our IFRS and Consolidation department, and they will guide you through most of the slides about when do we have control, when do we have power, and etc. Everything you need to know about when do we have control. Just as a reminder, those are all the webinar series of this year. We may add maybe something additionally for a live session, not only a webinar in the second part of the year, but we will inform you about that later on. Okay, so let's start. The introduction, there's and actually have three strategic investment types in IFRS. It's about when do I control a reporting entity, when do I jointly control a reporting entity, or when do I have significant influence over a reporting entity. And maybe important also, I'm using the word reporting entity. What does it mean? That's the entity that is required or chooses to prepare IFRS financial statements. It can be a subsidiary, it can be a parent, it can be a joint venture, but that's all about a reporting entity. It can be a single or a portion or a group, or even it doesn't need to be even an entity. So a reporting entity can also be a business unit. It can be a combination of two business units of two different entities, for example. But that will all come clear later on. And there's a clear interaction between all those standards. We always start with control. Do we control the reporting entity by itself, the investor who is a parent in a way? It can be through equity shares, but it can also be through a contract. Do we control it? Yes, then IFRS 10 will be applicable. You will have non-controlling interest, you will have loss of control, you can, etc. All the things that can happen. And IFRS 12 is applicable for the disclosures. You have joint control. Joint control is I don't have control. Then the question is, do I have maybe joint control with another investor? So both investors control an entity. Then you will deal with IFRS 11. And IFRS 11, we will deal with that in the next session. You have two types. It can be either a joint venture, for example, if it's an entity, most often or always it will be a joint venture, or it can be a joint operation. We always said that, well, proportional consolidation is not possible anymore. That's true. But there's one little exception that is similar to a joint operation. To proportional consolidation is dealing with a joint operation where you will recognize your equity share of each asset and each liability. That's a joint operation. Joint venture will apply equity accounting. If it's not a joint venture, you will determine, well, maybe do I have significant influence then over the entity? If it's yes, equity accounting. If it's no, most often it will be IFRS 9. IFRS 9, and again, always IFRS 12 deals with the disclosures, and sometimes also some other IFRS guidance will give you additional disclosure requirements. Okay. One moment. Okay. So what is the objective of IFRS 10? IFRS 10 is I will also remove my my screen. All right. In IFRS 10, what is the objective? IFRS objective is we want to present consolidated financial statements in case of control. So we want to deal with what are the requirements for presenting consolidated financial statements. Then what are the principles? What is the principle of control? What are the criteria that I need to apply when I have control, and set control as a basis of consolidation? So we can only consolidate when we have control. We cannot consolidate when we don't have control, when we have joint control or significant influence. How do I need to apply then the principles? This requires quite some judgment. Sometimes it's very obvious that you have control. I have 100% of the shares. Very obvious you have control. But I have only 51% of the shares. It's not always so obvious that you then have control, even with 60%. I have seen structures where a parent had 75%, but had to conclude that they don't have control because of certain reasons, because of a contract, additional rights given to the non-controlling interest, etc. What are then the accounting requirements for consolidation? IFRS 10 will not specify how you need to consolidate with all the details. They just give you some principles, which are very high level. And then also IFRS 10 defines what is an investment entity and exception, because there will be some exceptions that you don't need to consolidate subsidiaries. And that's, for example, when you meet the definition of an investment entity. Some definitions. A group, it's a parent and its subsidiaries. A parent is the entity that controls the subsidiaries, one or more entities. That's very obvious. Subsidiary is an entity that is controlled by a parent, by another entity, and control of an investee is, and that's important here about the definition, is an investor controls an investee when the investor is exposed and has rights to variable returns from its involvement with the investee, and has the ability to affect those returns through its power over the investee. So in this definition, this covers everything about control, but has some very important elements included. And we will specify. It's about power, it's about variable returns, and it's about having the power to influence the variable returns, the link. And that is something we will deal with in the coming hour and a half when we talk about when do I have control or not. So the scope, when is it, when do I need to apply IFRS 10 or consolidated financial statements? There's some criteria, but you see already, you will ask about, okay, IFRS 10 has criteria, but in Europe, we have European law that defines when we need to present consolidated financial statements. So actually, normally EU law will always be determinative whether or not you need to present consolidated financial statements. But it can happen that for example, per EU law, you need to consolidate, but under IFRS 10, you could be accepted to consolidate. That's important. Then, in that case, very important is that you cannot say that the financial statements will be prepared in compliance with IFRS as been issued by the IASB. Then you will have to say it's compliant with IFRS as adopted by the EU. So like most of the European companies that are public quoted, they need to have consolidated financial statements. They will always use IFRS as adopted by the EU. But that's important. It can also be reverse. We need to do it per EU law, but not per IFRS 10. Always say, well, it's IFRS as adopted by the EU. What are the conditions? Very common. If the company so except you need to comply with all. If you're a wholly owned or partially owned subsidiary and the other entity does not object, or the owners do not object presenting consolidated financial statements, object means there's it doesn't need to be explicit, but the non-controlling parties do not object in not presenting consolidated financial statements. And the not object means it can be through voting, but it can also be implicit. So it doesn't need to be explicit. Also important in this point is sometimes some non-voting rights, non-voting shares. We have seen that you can have preference shares, for example, or other non-voting shares, but they cannot vote, but they should also consent not to presenting consolidated financial statements. So very important here is that you cover all the shares in 4.1. Point 2, you're not traded in a public market. But anyway, if you're traded in a public market, per EU law, you will always have to do prepare consolidated financial statements. You not intend to be traded in a public market, not intending to do an IPO. And there's an ultimate or intermediate parent that produces IFRS financial statements that are available for public or that when you're part of a group or a parent, and the parent will measure the investment in your entity at fair value through profit and loss per IFRS 9. So all those four need to be met. And there's an exception for investment entities. Investment entities don't need to apply consolidated financial statements. And there's also an exception to post-employment long-term benefit plans. If you have a fund, a pension fund, and the pension fund invests in subsidiaries, they don't need to prepare consolidated financial statements per IFRS 10. And there can be a local law, EU law, or another local law that requires it. Then you will have to do it. So the local law is always first in determining whether or not we need to prepare consolidated financial statements. Some special cases. Well, if I have an entity that's no longer a parent at the end of the reporting period, well, in that case, very often you will have to prepare consolidated financial statements, because during, for example, an entity and it sold its only subsidiary on November 30th, and so at 31st of December, I'm no longer a parent, I'm a single entity. Do I need to apply consolidated financial statements? Well, in that case, yes, because you still had 11 months a consolidated result that you need to present. So it will be consolidated financial statements. Also, your prior periods will be consolidated financial statements. So answer is yes. If it's during the reporting period, you had a subsidiary that you controlled and you meet you don't meet the exception criteria, you need to consolidate. A very typical one is, and you see it more often and often, is combined or carve-out financial statements. Combined is I will put certain entities together into a group of entities that are not there is no parent in combined financial statements. There's no parent of those entities, of those two groups, but I will put them together. Often they call it consolidation, but this is not correct. You always need to use the word combined financial statements. A carve-out is when I have a subset of a group and I will prepare consolidated financial statements or financial statements, combined financial statements for that. There's some considerations. It's only allowed per IFRS 10 to prepare it when you have common control. So you need to have, if you have two groups and want to combine it, in Belgium we call it a consortium, for example. When you have it, it needs to have common control. Meaning common control is that the investors that control the entity, or there's one or more investors that control together then, or each individually, can only be one person who controls, but or one or a group of investors that controls an entity, the group 1 and group 2. In that case, you may meet the criteria. Very important also is that you really understand what is the purpose and who are the intended users. Sometimes when you do filings, it will be the regulator, the FSMA in Belgium, who requires you to prepare consolidated, combined financial statements. Or you can be a consortium, and per law, you're required to prepare, in Belgium, we will call it consolidated, but under IFRS, we will call it combined financial statements. In that case, those are still general purpose financial statements. So it's for a broad public that can have access to those financial statements. But very often it's also special purpose. Is a bank asks it, for example, or one of the investors requires you to prepare combined financial statements. In that case, it's special purpose, and that you will always have to explain. So the purpose and the intended users need to be explained in the disclosures of your combined financial statements. So in the, as of the notes, you will really explain why you have combined, and also about the preparation is really about the disclosures about it, how you will explain it. And also in combined, you will apply the consolidated consolidation procedures maybe, but maybe not everything. So you will have to explain what you did and what you did not, for example. Okay. This is a little example. For example, there's an intermediate parent P, and they have 3 subsidiaries, 1, 2, and 3, and they are preparing for an IPO. And the regulator asks, they didn't do historically financial statements consolidated because they were exempted. They were not meeting the local criteria. And we know that before filing, the 3rd subsidiary will be carved out and will be sold. Will be sold or will be transferred to the ultimate parent in that case. And it will happen prior to listing the shares public. So it will not be a part of the group afterwards. In that case, the regulator asks you in the prospectus to prepare combined, or you can call it carve-out financial statements. You will prepare combined financial statements that include the parent P, the intermediate parent P, subsidiary 1 and subsidiary 2. Because in the prospectus you want to show how it will look like after you're quoted. It can be also called a pro forma, for example. But what will happen afterwards when you're quoted? We are quoted in November 18, so and we are listed in January 2019. I will have to make public financial statements per EU law because I am a group. What you will have to do then in that case is that what for 2018 and 19 is that when you prepare consolidated financial statements, you always have to include the 3rd subsidiary because you control the subsidiary at that moment in time. You see, so in 18 you will include S3 in the consolidated financial statements, not the combined. And also for 19 it will only include up to November the results of the 3rd subsidiary. You see, and also the comparatives, of course, will include S3. So there's really a distinction between combined financial statements and consolidated. You can only talk about consolidated when we fully apply, with no exception, IFRS 10. So you cannot do certain set your own group, for example, and still call it consolidated. So even for consortium in Belgium, you will have to call it combined, not consolidated. But I see often quite some still companies who are using consolidated in that case. Investment entity. An investment entity is a call it, it's like a holding or a fund, and the fund has a large group of investors. It can be other companies, it can be family offices, etc. And with the proceeds of those funds, they will invest in entities. They may take majority stakes, they may take minority stakes, but really the purpose of the investment entity is really solely to have returns from capital appreciation. So we will sell it at a certain moment in time, or we will earn investment income. For example, also private equity. Private equity can often meet the definition of an investment entity because they're not looking to control an entity on the long term, but then really looking to making a significant return on their investment in a period of 3 to 5 years, and then bring it again to the market through an IPO, selling it to another private equity, etc. And also the entity measures and evaluates performance of substantially all the investments on a fair value basis. In that case, you don't need to apply IFRS 10 when you meet the definition, and you will apply IFRS 9. IFRS 9, which will require that you measure the shares at fair value through P&L normally. And also, you don't need to apply IFRS 3 business combinations neither when the investment entity acquires a majority stake in another entity. What's important is if the investment entity would have 100% stake in another entity, and this other entity is only for the sole purpose of delivering services, investment-related services to the investment entity, in that case, you cannot use the exemption. And you will have to consolidate the investment entity with the only subsidiary which is delivering services, and have really the stakes in the operational entities and your investments through fair value. Okay. Voila. That's a short introduction, and now it's all about control. We only need to present consolidated financial statements and include the entities that we control. But what is control? Control it's really dependent. Control will be obvious or will be a gray zone. It's either two, but the gray zone is often there, and you will have to look to determine control. You will have to understand all the facts and circumstances. You will have to look to the shareholder agreement, not only the SPA, but look to the shareholder agreement. Look to the security agreement. Look how they will deal with governance. So the understanding of the purpose and the design of the investee, and what are the relevant activities of the investee is in fact very important. But in order to have a parent has control over a subsidiary or over an entity, there need to be three components that need to be there. First of all, the investor need to have power. They need to have rights that give and that's important, the ability now, the current ability. They need to have the ability today to direct the relevant activities. And what are the relevant activities? We'll come back on that later on today, but those are the activities that significantly affect the investee's return. Return can be a fixed amount, but normally it should be variable. It should be exposed to and has rights to variable returns from its involvement with the investee. If the investor only has a fixed return, for example, I only have preference shares, and that give a return of 11%, and that's it. I have no other rights, even if it's sold. Well, probably you will not meet this criteria. And then, of course, you need to have the power to influence also the relevant activities that affect the investee's return. So the variable returns. You need to have power to affect the variable returns, and that's what we call the linkage all together. So throughout the session, we will use a case study. There are also other examples, but we'll use a case study, and I will explain you that, and we will do the first analysis of understanding the design and the facts and circumstances around this contract. And we are talking about a company A, for example, in Belgium. It's a group, and they want to enter the market in China. Currently, they're in Europe, and they are developing and printing 3D printed implants to plant into the human body. Yeah? And they have, for a lot of Europe and for the US, they have obtained European approval and also the FDA approval to market those or some of those implants in Europe and the United States. But they want to enter the Chinese market, which is very big, and they're willing to cooperate with a Chinese company to market those implants in China. Why willing to cooperate? Because the Chinese regulator always asks that the manufacturing should be done through a Chinese entity. It's a very specific market. You need to have a very specific knowledge. So that's why the company chooses to cooperate with an existing Chinese company who has the expertise of the Chinese market for those medical devices. So, and how will they do it? They will agree an arrangement. A will agree an arrangement with the Chinese partner, then company B, to create a new entity, a Chinese entity, to meet the regulator's requirement, and each party will have 50% interest in company in the company C. If you would look to that, you would say, oh, that is a joint venture. That's clear, because 50% it will be joint venture. Well, you need to look much further. You can have control even here, and let's go through it. So what is the objectives here is get an understanding about the investee and the role and risk for each party and the arrangements. So questions you need to ask is, what is the objective? Why do we set up this company C in China? How will be the governance? The governance at the shareholders meeting, the governance about the board, what tasks can be taken by management, and who will be management in that case? Who is the key management members? How decisions will be made? Is it through simple majority? Is there a casting vote? Is it with majority of for example 75%, or does always one member of company one director of company A and one director of company B need to approve? There are a lot of things that can happen in the governments. Are there any rights that need to be approved, specific rights? Very thing, but we will deal with that also later on. What are the relevant activities? Relevant activities for those company C, and for those activities, what you need to do today and in the coming future. This is not so obvious what are, and this really depends on company by company, industry by industry, what the relevant activities are. What is the role of each investor? Are there any other contractual arrangements? Are there any financing, licensing, manufacturing agreements, etc.? What are the risks? How are they exposed to risks? And how are those risks passed on to the parties who are involved? So a lot of questions you need to ask in order to understand, and which will help you to determine then, do I have power over the variable over the relevant activities, so direct relevant activities, to generate variable return of company C. So why an objective? So company A is willing to enter the market, implant Chinese market, can only do it to a Chinese entity, like I already explained. They're using a company B who has specific knowledge about this industry, about the Chinese market, and about the regulated environment, because we will have to obtain also regulatory approval to market this product also in China. They also have a network, for example, company B, about hospitals and doctors. They will form together a company and the objective of this company is first obtain regulatory approval to market the 3D implants, build a 3D manufacturing plant in China, and market those implants on the Chinese market to the hospitals and the doctors. And at the future stage, but this is not clear, this company C can also develop its own implants. Now there will be the implant that is developed by company A in Belgium, and that will be licensing this IP to company C. There will be shareholder agreement, 10 years, and 10 years, 50-50. You need to read it once. Board of directors is 4 persons. Each party has 2. Decision making is with a simple majority. Normally one company in that case cannot approve a decision. And they specify when the board needs to decide. Which decision needs to be taken by the board, always cannot be taken by management. The annual budget, capex, financing, working capital, pricing policy, marketing requirements, HR requirements, and R&D. And there's a deadlock for the moment, which is temporarily, is that the company A has the first 2 years a casting vote. When they do not agree, that's 2-2, they have a casting vote to decide. But after 2 years, there will be a mediation company that will make a proposal of voting. Okay. So, and the activities of company C are obtaining market authorization, manufacturing, commercialization, research and development, managing assets, and financing and funding. So try to remember a bit this case study, because we will deal with that throughout this session today, talking about control. And there's some other contracts. So A has a licensing agreement to C, which is a fixed with a fixed amount, and then also a royalty percentage. Supply and manufacturing agreement by A to C for the raw materials to develop or to manufacture the implant. And there's also a financing agreement where A will fund also to a certain amount the activities of company C. With a loan which is repayable, which is interest bearing as from a certain amount in time, actually as from the product is marketed or is obtained regulatory approval, then it will become interest bearing and you will have to repay it also with certain installments. Okay.
Yeah.
Okay, Evelyn, it's all yours now.
Yeah, thank you. So now we're gonna dig a bit deeper. So to recap, you have control when there is power, return, and linkage. So first, we're gonna have dig a bit deeper in the definition of power. So an investor has power over an investee when there are existing rights that give the current ability to direct relevant activities. So there are 2 important concepts in this definition. So we have the existing rights and the relevant activities. And in the upcoming slides, we're gonna explore a bit more these definitions. So it's important that you determine, okay, what are the relevant activities? What is the way decisions are made about the relevant activities? And what are the rights that that the investor, but also sometimes other parties have in relation to the investee? So for example, sometimes it can be possible that you have power even if there are other entities which also have the existing rights that give them the current ability to participate in the direction of the activities. So that's the case when there is significant influence. So then they have power. The other investees have power to participate in the decision, but they do not have power itself, and they do not have control themselves. There is just like significant influence. But what are now the relevant activities? So that are the activities that significantly affect the investee's return. Examples are selling, purchasing goods and services, managing financial assets during their life, selecting, acquiring, or disposal of assets, research and development, or determining funding or a structure or obtaining funding. So these are just like examples. This list is of course not limited. Then, okay, I want to go to the next slide. Sam, do I have already control on the slide deck? Yeah. Okay, thank you. So some examples of decisions about relevant activities are establishing operating and capital decisions of the investee, or for example, appointing and remunerating investee key management personnel. So it's important an investee with the current ability to direct the relevant activities can have power, even if they do not have yet the rights that are exercised. If there is, for example, also evidence that the investee has been directing activities in the past, this can help you as an indicator whether the investor has power or not, but it's not conclusive, because if they has been directing, they do not have the current ability, and that's also an important thing in the definition. They really need to have the current ability to really direct the activities. Sometimes it can be the case that there are 2 or more investors, and they each have the existing rights to have the ability to direct the relevant activities. And in that case, it will be important that it is decided, okay, who now most significantly affect the return of the investee. But later on in the slide deck, we will have an example on that. But let's first, maybe via a little poll, practice the definition of the relevant activities. So based on the case study, some explained earlier, I've listed up some of the activities, and now it's up to you to indicate, okay, which are now relevant activities and which are not relevant activities. So maybe to shortly repeat, the relevant activity is an activity that significantly affects the investee's return. Okay, I see a lot of people are voting. Okay, I don't see any movement on the voting, so we will close the poll. And I will go to the next slide, in which you'll see a summary. Yes, I think I do not manage to go.
Yeah, you can go to the, if I do share, you will see the results now.
Okay, yeah. So indeed, so here are the results. So the first one, obtaining the market authorization for the Chinese market. Okay, I see a lot of people see it as a relevant activity. That's indeed true, because without that market approval, the implants cannot be commercialized, and that was the main objective of the company C. Then the second one, manufacturing. Indeed, again, a lot of people see it as a relevant activity. That's correct, because yeah, the manufacturing will be needed to, at the end, obtain your regulatory approval, and will of course significantly impact your margin. Then the commercialization. Again, a lot of votes on that one. That's indeed also correct. So it's a relevant activity because it's important. You will need to have a good network with the hospitals. You will need to have a good sales force, a good commercialization strategy to really sell your products. And then the next one was R&D. Okay, a bit less votes. But still 57%. But in fact, that is at the moment not a relevant activity, because at the moment, company C is not developing itself the implants. But in the future, of course, if they will do, then it becomes a relevant activity. But at the moment, that's not the case. And then managing assets, there we see also a lot of votes, but in fact, it's not at the moment, it's less relevant at the moment, because the company does not have its own intellectual property. Okay, yeah. So this is the summary, yeah, what I just explained. Good. For the next Yeah, Are you now going to the next slide, or am I doing it? But it's but the lack of time.
I am doing that, but I will. One moment.
Yeah, but it's okay. Okay, just said I know. Yeah, okay. So here is again, so this is a general example of a case in which we have two investors. So there are two investors together. They form one investee, and the objective is to develop and to market a medical product. So one investor will be responsible for really developing and obtaining the regulatory approval of the medical product. So they have the ability to make all decisions related to the developing and obtaining the approval. And once the approval is then obtained, the other investor will come in the picture, and that investor will be responsible for manufacturing and marketing the product. So they will take all decisions about the relevant activities related to that one. So here it's important, because there are two different investors, that it is determined, okay, who is now most significantly affecting the investee's return? Is it the one who is developing and obtaining the approval, or is it the one who is manufacturing and marketing the medical products? So on the next slide, you will see some examples which can help to make that decision. So you would need to consider, okay, what's now in fact the purpose and the design of my investee? What are factors that are really determining the profit margin, the revenue, the value of the investee, as well as the value of the medical product? What is really the effect on the return resulting from each investor who is making his decision? So the first one will make the decision on the developing and obtaining the approval. The second one on really commercializing the products. Then you will need to look at the investors' exposure to the variability of the returns. And in this specific case, it will also be important to consider, okay, what's the uncertainty of obtaining the regulatory approval? So for example, when the investor has already a lot of experience in obtaining such approvals, it can affect your decision, of course. And then the last one, which investor controls the medical product once the development phase is successfully. So for example, in this case, assuming that the approval will take 5 years, then potentially in the first 5 years, the first investor will be the one who most significantly impacts the investee's return. Once the approval is received, it will probably be the second investor who most significantly affects the return. So it's important that over time you always should reassess all these parameters, because of course the power can change over time. Then the second concept in the definition of power was existing rights. So rights can be obtained by, for example, voting rights via shares, but it can also be via agreements. So it's really like a very extensive definition. So here we see like some examples of rights that can give an investor the power. It can be individually, or it can be in combination. So it can be rights via voting rights or potential voting rights. It can be just the right to appoint, to reassign, to remove members from the key management. It can be the right to appoint or remove another entity that directs the relevant activity. It can be the right to direct the investee to enter in transactions that would bring up some benefits for the investor, or it can also be other rights which are stated in contracts. So on the next slide, we see then that it's important your rights should be substantive. So that means that the holder must have the practical ability to really exercise the rights. So if there are, for example, just like some protective rights, then you will not have the ability to exercise your rights. That will not mean that you have power and that you have control. So it really needs to be substantive. And it needs to be exercisable at the moment when decisions need to be made about the direction of the relevant activities. But in the next slides, there will be some examples on that one. So the fact whether a right is substantive or not depends on several factors. So the first factor is, okay, are there some barriers that would prevent the holder to exercise their rights? It can be economical, legal, operational. So for example, if there are financial penalties, then that's really a barrier for the holder to exercise their rights. If there is a high exercise right, if there are narrow exercise periods, that can all prevent that the holder will really exercise the rights. Or for example, when there is an absence of a mechanism or information about how to exercise, or in case there are legal or regulatory barriers. For example, in case a foreign investor cannot exercise their rights because of the law, okay, then it's really like a barrier that at the end will prevent the holder to exercise the right. The second factor is whether so that's on the next slide, is whether the holder really have the practical ability to exercise their rights when there is an agreement with two or more investors. Because the general rule is, okay, the more parties which are involved, the less likely it is that your right is substantive, because there is always a chance that you will not be able to really exercise your rights. It's important in that case that a mechanism is in place that that provides parties with the ability to really collectively exercise their rights. So in case the mechanism is missing, then probably the right will not be substantive. Then the third factor is, okay, would the investor that holds the rights really benefit from exercising the rights? So if the potential voting rights, for example, is in the money, okay, the investor will benefit from exercising the rights. Or in case if the right is exercised, there is really like a synergy between the investor and the investee that will also mean the investor really benefits from exercising the rights.
I think there's a question about, can you give maybe an example of a barrier by law? I don't know if you have an example, otherwise I can give you an example. Okay.
Yeah, yeah, go ahead.
Okay, well, I think it was with a large logistic company who has activities worldwide, almost in every country in the world they were present, and there was, I think, one country, I don't recall the name, which country it was, that required that at least 50% of the shares were held by a member, by a company or a person which is domiciled into that country. And what the company did is that they also had created an option, a call option on those 50%. This is no potential, I'm a little bit further, but just give you an example about a barrier, is that in that case, well, that call option, you will not, it has no value, it has no substantive value, because you will breach the law when you exercise the call option. So the call option itself doesn't have any substantive value in evaluating whether or not you have existing rights. So you need to look into, in that example, about the 50%, because by law 50% needs to be held by a company or a person domiciled in that country.
Yeah, indeed.
Okay.
So on the next slide, we will see then, so it's a general example, and it's related about the fact that it's important that your rights are really exercisable at the moment you need to make your decisions. And on top of that, that the rights can also be substantive, even though it is currently not exercisable. So the case is, so you have an investee which has an annual shareholders meeting on which decisions are made on the direction of the relevant activities. And that next shareholders meeting is planned in 8 months. But shareholders which have individually or collectively more than 5% of the voting rights, they can call together a special meeting in which they can change the existing policies. But they give notice of that at least 30 days on beforehand. They give notice of that to the other shareholders so that they are aware of that special meeting. So we have 4 scenarios. So scenario A on the next slide is a case wherein the investor holds the majority of the voting rights. So in that case, the investor's voting rights are substantive. So it is the majority. The investor will be able to make decisions about the direction of the relevant activities when they need to, because they have the majority. The fact that a special meeting which can change the policies will be held within 30 days does not prevent the investor that he now has the current ability to direct the relevant activities. So that means in this case, the investor has power. Then we have scenario B. So in that case, the investor is party of a forward contract to acquire the majority of the share. So via that forward contract, it will be obligated to obtain the majority of the shares. And the settlement of that contract is within 25 days. So that means that the existing shareholders will not be able to hold that special meeting to maybe change the policies because they need to give notice of 30 days, but the contract settlement is already within 25 days. So that means that this investor, in fact, has essentially the same rights as the majority shareholder of the previous example. So that the investor's forward contract provides the investor with a substantive right that gives the investor the current ability to direct the relevant sales, even though the forward contract is not yet settled. So here again, the investor has power. Then we have a third scenario. So in that one, the investor has a substantive option to acquire the majority of the shares, and that is exercisable in 25 days. And at the moment, they are deeply in the money. So here again, the same as scenario B, exercisable within 25 days. So the other shareholders will not be able to set up the special meeting to change the policies. And here again, the investor has power. And then we have scenario D. So it looks like a bit the same as scenario B. But in this case, so again, there is a forward contract to acquire the majority of the shares. But in this case, the forward contract will only be settled within the 6 months. So in this case, the investors do not have the current ability to direct activities because the other shareholders can hold that special meeting and they can change the existing policies over the relevant activities until the moment the forward contract is settled. So in this case, the investor does not have power. Okay. So then a bit more about protective rights. So protective rights are really designed to protect the interests of a party without giving that party really a certain power. So it's more like to protect the minority shareholders. Examples for that one are restrictions to really take activities that can significantly change your credit risk. So to avoid that you take decisions and that that there is a high credit risk. Or another example is the approval of capital expenditures greater than a certain amount to avoid that some expenditures are done which are not really in the course of the business. Another example is approval on the issuance of equity and debt instruments, veto transactions between the investee and the related party transactions, or, for example, the sale of a business, winding up of a business, sale of assets, so to avoid that those decisions can be made and can have an impact on a party. For that, in that case, there are protective rights so that they can also be part of that decision. But what now about veto rights in general? So in veto rights, you can vote against the decision and you can set your veto. So in that case, you always need to consider the complete package. It all depends on the nature of your veto rights, of course. If you put your veto rights because the policies will be changed of operational and financing decisions, that really affects the investee's return. So that's not a protective right, because important decisions can be made by changing the policies. But like, for example, just changing your auditor or changing the name of the investee, that's more like a protective veto right, because okay, you can be part of the decision, but it does not really affect the investee return. The same for budget approval rights. Sometimes it is that budget needs to be approved, and it's just like a protective right because it's once a year, it's not in detail, there is no follow-up by the party who has the protective rights, so it's just like to protect them. But there can also be a substantive right in case they really have the right to be involved in the budget. They do some follow-up on the budget. They need to approve the budget several times per year. Then it's more a substantive right than a protective right. So it's important. You really need to look at the bigger picture and investigate all different decisions. So it's not that on a certain topic you decide it's just like a protective right and not a substantive right, that you can decide, okay, there is no power. You really need to look at several indicators, put everything together, and then make your decision. Okay, do we have power, or do we not have power? And also it depends, okay, if there are cases where it's substantive, what's the weight of that decision? Is it like really something important on which you have the substantive right, or is it not, or is it not that important?
I have here another question that I can answer, Evelyn, is that when you have certain, often you see that in the board matters, for example, that they call that where the board needs to approve with more than simple majority, for example, is the acquisition of a new entity or a merger, for example. And so often it's a question, is that a protective right or not? It can be a protective right if it's fundamental protective right, but it can be both. But you need to, I think in that case, you need to look to really what is the purpose of this entity and what is the strategy and how will they meet their strategy? How can they meet their strategy? To give you an example, there was I think it was a company. It was in a company and there's two parties in it, where one party as a board, the board matter that needs, where the other party, which has a non-controlling interest, has a right or needs to consent, so a positive vote on the acquisition of a new entity. And in that case, the strategy of the company was really a buy and build strategy. So they really want to grow not only by its existing business, but really also by buying other entities. So in that case, it is certainly not a protective right because it's part of the strategy. Having the approval of the non-controlling interest for an acquisition, this is really a substantive right. It will be different is that this will be occasionally or rather exceptionally. And in the past, the company has been growing or organically, and they really intend in the strategy to continue to grow or organically. In that case, it can be also a protective right. So it's really a gray zone, but really look to, like Evelyn says, really look to all the facts and circumstances, look to the strategy, what is the intention, the purpose of this entity, etc., to determine whether or not it is a protective right. Okay, sorry, Evelyn, go ahead.
No, it's okay. Then the next one is about voting or similar rights. So there are in fact 3 cases. So you can have power with the majority of the voting rights, you can have no power although you have the majority of the voting rights, or you can have power without having the majority of the voting rights. So the first one, is like simple. So you have power with the majority of the voting rights. So you have 50% plus 1 vote in case of a simple majority. So that's like a clear situation. Sometimes it's possible that even though you have the majority of the voting rights, you do not have power because the relevant activities are, for example, directed by another party because the rights are stated in a contract, or your voting rights are not substantive. So you are not practical able to really exercise your rights. That's, for example, the case when your activities are directed by the government. Or sometimes the voting rights have been delegated to a decision maker or an agent. So, and then the third situation is when you have power without the majority of the voting rights. So that's called de facto control. But later on, we will see an example on that. So that will really depend on the size and the number of the voting rights that the investor has compared to the other investors and how the other voting rights are spread. It can also be the case in when there are potential voting rights or when there are whether some rights are stated in contractual agreements. But on the next slide, we will see then an example of that. So we see here company A holds 48% of the voting rights in company B. And the remaining 52% are really widely spread over other shareholders. And none of them has more than 1% of the voting rights, so really widely spread. So in that case, even though company A does not have the majority of the shares, because it's less than the 50% plus 1 vote, even though that, the A still has power over B, because A has the dominant voting interest, and the 52% of other shareholders, they really will need to work together to agree and to outvote A. So that's mainly, let's say, impossible. So here we say, okay, A has really power over B. But then in a next example, so A holds 45% of the voting rights, and then the remaining voting rights are spread over 2 bigger shareholders, which each have 26%, and then like 3 smaller shareholders, which have only 1%. So in this case, we can conclude, so the company A does not have the majority, but even though they also do not have power, so they have more voting rights compared to the other shareholders, but the other 2 shareholders, which have 26%, they can really work together and cooperate, and they can easily outvote company A, because together they have 52% of the voting rights. So that's why in this case, A does not have the power over company B. And for the so the next slide is about the potential voting rights, and for that one, I will give the floor to Thijs.
Yes, hello, thank you. I will be discussing the last element in the power assessment, namely the potential voting rights. When assessing whether an investor has power over an investee, you should always consider the potential voting rights that you, as an investor, hold, as well as potential voting rights that are held by other investees or other investors. The most common examples of potential voting rights are options, forward contracts, and conversion features of a convertible instrument. These potential voting rights are only considered if they are deemed to be substantive. So as Evelien already explained, substantive means that you have the practical ability to exercise the rights. The most common factors to consider whether an option is substantive are presented in the matrix below. So the three key elements that we consider are the exercise price of the option, the financial ability of the investor to exercise it, and lastly, the exercise period. Let's first have a look at the exercise price. IFRS 10 is very clear that the exercise price can and should always be considered in evaluating whether an option can give power. The facts to consider are whether or not the option is in the money or deeply out of the money. IFRS 10 does not define the term deeply out of the money. However, a call option with a strike price that is significantly above the value of the underlying interest in the investee is mostly considered as deeply out of the money. So that would be a non-substantive option. When your option, however, is in the money, it will be a substantive option and it should be included in the power assessments. And then you have an option that is out of the money or at market value. When assessing this one, you have to look at other facts and market circumstances. For example, if you have an out of the money option as an investor, but if you would exercise the option, you would realize important synergies between you and the investee. It can be a substantive option, despite the fact that it is out of the money, but due to the fact that you can realize important synergies. The second thing to consider when having a look at the exercise price is to have a look at the evolution of the exercise price. So it's not because an option is deeply out of the money now, but it will be over the course of the exercise period. So you really have to look over the course of the exercise period, whether or not the option can become in the money. The second criteria of evaluation is the financial ability of the investor to exercise the option. You can already see that these two elements of this element is very closely linked with the exercise price, because the holder of an option that is deeply out of the money will have difficulties finding external financing to finance the option. On the other hand, for example, you can have the holder of an option can have excess cash or financing readily available. In this case, the option will be most likely deemed as substantive. And then again, as with the exercise price, you have the elements of the element where you have the possibilities to raise financing, or for example, an out of the money option. To consider whether or not this scenario is substantive, you have to look to the facts and circumstances. So again, the same scenario, if you have an out of the money option, but by exercising it, you can generate significant synergies, then it could be deemed substantive because you, as an investor, have the ability to raise the financing. The last factor to evaluate is the exercise period. To have power over an investee, you as an investor must have existing rights that give you the current ability to direct your investee's relevant activities. This was already explained by Evelien and also with Sam. However, the term current is important here in this definition because often current means as of today, but in IFRS 10, current refers to the ability to make decisions about an investee's relevant activities when they need to be made. What do I mean by this? For example, imagine that you have an option that is not exercisable at inception, but it will only become exercisable within 100 days. While the first board meeting of the investee, where all important decisions will be made over the strategy, the capex, the budgets, and so on, is only within 200 days. Then the option is still considered as current because you can exercise it before the first board. So an exercise of an option that is not exercisable will be considered as non-substantive. An option that is currently exercisable will always be seen as substantive. And then in the example that I just gave, you can also have an option that is exercisable before decisions need to be made. So depending on the facts and circumstances, it can be also deemed substantive. I think we have a couple of examples on the next slide. Yeah, I have the control. So in this first example, we'll have a look at investor A, who holds 70% of the voting rights in an investee, and a second investor who holds 30% of the voting rights. However, the investor B also has the option to acquire half of investor A voting rights. So if investor B would exercise the option, it would end up with 60% of the voting rights. The option is exercisable for the next 2 years at a fixed price, but it is currently deeply out of the money. Investor A has also been exercising its votes and is actively directing the relevant activities of the investee. In this scenario, investor A is likely to meet the power criterion because A has 70% of the voting rights currently, and they have the history of directing the relevant activities of the investee. Despite that, investor B has the option to acquire the majority of the voting rights, we will not consider investor B to have power, since the option is deeply out of the money, and it is considered that it will remain deeply out of the money over the 2-year exercise period. So the option is not considered substantive. In the second example, I don't know. Do I have still control? Yeah. So in this second example here, we have a look at investor A and 2 other investors who each hold 1/3 of the voting rights of an investee. The investee's business activities are very closely related to the one of investor A. In addition to 1/3 of the voting rights, investor A also holds a convertible debt instrument. If this debt were converted, A would end up with 60% and thus a majority of the voting rights in the investee. Currently, the debt instrument is out of the money, not deeply out of the money, but it is out of the money. However, investor A would greatly benefit from realizing synergies if they would obtain the majority of the voting rights. In this scenario, we can conclude that A has the power over the investee because it holds the voting rights of the investee together with the substantive potential voting rights. And that would give investor A the current ability to direct the relevant activities. So despite the fact that in the beginning of this case, investor A only holds 1/3 of the voting rights and the option is out of the money, due to the fact that A can benefit greatly from realizing synergies, A is deemed to have power over the investee. The next step in assessing whether or not you have control as an investor is the exposure to variable return. So this is the second criteria we have for assessing whether or not you have control. When you are exposed as an investor to variable returns, it is deemed that you have control over the investor. However, you have to have a deeper look. First of all, when you as an investor are exposed to variable returns, it is due to your involvement. So it means that your returns can be positive, they can be negative, but they can also fluctuate, of course. They can be both positive or negative. And although only one investor can control an investee, multiple parties can share in the return of an investee. The most common example in this are the holders of non-controlling interest, who can share in the profit or the distributions of an investee. The most common example of variable returns are dividends, remuneration for services delivered, or economies of scale. It is, however, very important to note that simply having the exposure to variable returns from your involvement does not automatically mean that you have control. To control the investee, you need to have power over the investee and the ability to use this power to affect the amount of the returns. But we will come back on that in the next step in a couple of minutes. It's also important to stress out that the existence of exposure to variable returns is sufficient. It is not important or not the amount of the exposure of the variable returns are taken into consideration. Let's have a look at the next slide, in which we have some examples of variable returns, which are linked to the case that Sam discussed in the beginning of this webinar. So remember our investor A, we as party A, we founded a subsidiary or an investee C together with a Chinese company B. We as investor A, we get milestone payments from a licensing agreement. And these milestone payments were fixed. However, they are considered variable because as an investor, we bear the credit risk. The second variable return are royalty payments from the licensing agreements. This one is more obvious that it is a variable return because it is a percentage of net revenue. The third exposure here was the fixed interest rate on the interest-bearing debt. Again, as with the milestone payment, it can be seen to be fixed. However, as an investor, we are subject to the credit risk, so it is considered a variable return. Dividends, again, is a more obvious example. It's variable because they depends on the net results. And then the sale of the raw materials under the supply and manufacturing agreement is obviously, of course, also a variable return. You also have an example, for example, of a fixed return. A fixed return can be, for example, a non-refundable fee that is received upfront and where you as an investor do not have exposure to credit risk. So that is an example of a fixed return.
So I can give also another example. This is we have a debt with the credit risk. If I go back to the slides, yeah. Oh, I'm going too fast now. Yeah. For example, fixed interest rate on interest-bearing debt, fixed but subject to credit risk. But if the interest-bearing debt would have certain guarantees, whereby the credit risk is really reduced to a very low level because of this, and in that case, you can also argue it is fixed because the credit risk is covered by substantive guarantees. It can be by the parent company. It can be in the example, by company B, and they're very they have a lot of, for example, a lot of cash, and they would reimburse, for example, or there could be several scenarios. In that case, it would also be fixed.
Mm-hmm. Yeah, exactly. So yeah, the greater as an investor your exposure is to the variable returns from your involvement in the FST, the greater the incentive for you as an investor to obtain more rights that give you power over the investments. However, this is not determinative for power. On the other hand, if your exposure is disproportionately greater than your voting rights or other similar rights, then this might be an indicator for power, but it has to be considered with all other rights and facts and circumstances. If we go to the next slide, we have a second case here in which I will ask for your votes. Sam, is it possible that I lost control? Yeah, thank you. So in this case study, we refer back to the case study that Sam discussed. And we have several definitions here in the agreement between A and B. And my question to you is, which of the following elements are in favor of power? I don't know if I can start the poll. So I will launch it now. So the question is, which of the following facts are in favor of power? So only those in favor of power have to be pointed out. I can see that the votes are coming in. All right, I will close the poll now. I think the majority of the people has voted. So close. And I will now try and share the results. Here we go. So we're only going to highlight the 5 elements here. So the first one was shareholder structure, 50% each voting rights. 43% of the participants voted that this is a fact in favor of power. However, this is not in favor of power. So both shareholder A and B have 50% of the voting rights each. This is not in favor of power. The second topic was relevant activities decided by board level. This is correct. So the majority of you answered that it is in favor of power. This is the fact because we, as investor A, we had the casting vote because we appointed the president of the board of directors. So in our case, this is indeed in favor of power. Then the licensing agreement, as we discussed earlier, the licensing agreement gives us exposure to variable returns. So this is in favor of power. The same goes for the financing agreement. So the financing arrangement is also in favor of power. Most people did not highlight this element. And then the casting vote in case of deadlock procedure is directly linked with the relevant activities decided by the board level. Since we, as investor A, we had the president of the board who has this decisive vote, it means that we have an indication of power in that. So I will now hide the poll results and continue to the slides. Yeah, so this is again a summary of which elements were in favor of power and which elements were not in favor of power. So the ones that were not included in the poll are the supply and manufacturing agreement, which is in favor of power. And then the elements that were not in favor are just the distribution of the number of directors, the simple majority, and the fact that each investor had 3 key management members. If we now continue to the next slide, we will have a look at the link between the power and the returns. So the link between the power and the returns is the last element to consider in the assessment whether or not you have control. As we already discussed a couple of times, it is very important that the link exists. So having the ability to use your power as an investor over the investee to affect the amount of the returns, this is a clear indication of control. In this link between power and returns, we have to consider the principal and agent discussion when decision-making powers are delegated, which is often the case. An agent will often have decision-making powers. However, they do not have control over the investee, since they will only act on behalf of other parties. The terms and conditions that should be considered when assessing whether you as a principal or whether you are a principal or an agent are listed on the slide. And the first one is the scope of the decision-making authority. As a decision maker, which activities are you permitted to direct? And do you have the discretion in these decisions? So that's the first important condition to consider. The second one is what rights are held by other parties and are they substantive? Let's have a look, for example, at removal rights for a decision maker. If a limited number of investors have a removal right and they have no significant financial penalties when exercising that removal right, then the right can be considered as substantive. However, if the decision maker cannot be easily replaced because they have very unique or specific skills, or the removal rights have very large financial penalties, then they will be considered as non-substantive. The third element here is the remuneration of the decision maker. So the third factor to assess whether or not you are a principal or an agent is the remuneration. The greater the magnitude and the variability of the remuneration linked with the activities of the investee, the greater the indication will be that you are a principal. So if your remuneration is variable and it is directly linked with the activities of the investee and the performance of the investee, then it can be an indication that you are the principal in the relation. And then the last factor is the exposure to variable returns, as we already discussed, but then through other interests. And to explain this point, we have an example on the next slide. So let's have a look at this example. Company A has a 40% interest in company Z, whose relevant activities are directed by the voting shares. So based on the first fact, we would not consider or conclude that A by itself has control over Z, since they only have 40% of the voting rights. However, there is a second entity, B, who holds a 15% interest in the same entity, Z. A also evaluates that under all facts and circumstances considered, that B is an agent of A in this situation, because A and B are members of the same group. A and B have the same ultimate parent. So based on the combined interest, A can conclude that it controls Z, because A has a direct interest of 40%, and A also has a principal-agent relation with B, who acts solely as an agent for A in this situation. Since A considers and concludes that it has control over Z, it will consolidate Z in its financial statements fully, but they will recognize a non-controlling interest of 60% in its consolidated financial statements. So in this scenario, A is a principal, because A has a current ability to use its power to affect the industry's return. If we then go to the next slide, we will conclude this webinar session. So we discussed the fact that to assess whether or not you have control, you need to have the clear indication of power. You have to be exposed to variable returns, and the link between the power and the returns have to be present. So you have to be able to use your power to affect the variable returns. However, it is important to notice that you, as an investor, have to reassess whether or not you control an investee when facts or circumstances change. For example, the power can change because potential voting rights are granted, or they are expired, or they are modified. Yeah, your exposure to variable return, it can also change because a licensing agreement comes to an end, or it's replaced by a new contract. So it's very important to take away that after the initial control assessment, you do have to continuously assess whether or not facts and circumstances are changing and indicating that there are changes in the elements of control. In the second webinar concerning control, we will have a closer look at the consolidation procedures that are linked to the control assessments. But I will give back the word now to Sam, who will inform you over the timing and the content of the upcoming webinars.
Okay, thank you very much, Tess, and also Evelyn. Thank you very much for this hour and a half. I think we will have our next session on, and honestly, I have forgotten when we have the session, but we need to, I think you can find it on the slides. You have all subscribed. But in the next session, we will talk about the consolidation procedures. We'll talk about when do we have a joint arrangement, when we have a joint operation, a joint venture, an associate, how to apply equity accounting. It can be very straightforward, but it can also be difficult. There's sometimes some things that are not applied. For example, when you have, for example, intercompany transactions, but there's an intercompany transaction where one of the entities has recognized an intercompany asset, for example. In that case, this may lead to intercompany eliminations, even when we are applying equity accounting. And we will end with IFRS 12 disclosures. We will walk through an example of consolidated financial statements and show you what are the consolidation requirements to do that. Yeah, so I think we addressed also all the 3 questions that we have received today. So I wish you just in time, very great. Wish you all a very good afternoon, and see you later today. Not see you later today, but see you next time on the next webinar. Thank you very much. Bye-bye.